Hey everybody, it's John King. Appreciate you joining me today for my live stream that I do every single Friday, and today is no different. So today I'm going to be covering another financial topic related to the mortgage industry, and we're going to talk about a deep dive on how to buy a home when you are self-employed. And it's a bit of a different process because when you own a home, the process of buying a home. Hey Kathleen, when you own a home, the process of buying a home can be daunting and cumbersome to a significantly higher level than someone who's not a business owner. And there's a lot of reasons for that. And so really my goal today is to talk about what are some of those challenges that are different for people who are self-employed and how do we overcome those? Because it's critical to A, have awareness, and B, have options. And a lot of times people say, John, I'm self-employed. I know I'm not going to qualify. And so either A, I've got to wait a couple of years to be able to qualify, or B, I have to pay super high interest rates to get my loan. Well, there is a little bit of truth to both of those, but those aren't the only options. Those aren't the only ways that you can qualify. And so that's really what I want to cover today is what are the ways in which you can buy a home being self-employed, and what are some different things we need to be thinking about. So the first thing is, what is the difference between being a business owner versus my employees? I get a call probably once every 6 months or so from a frustrated business owner saying, I don't get it. I own the business. I've got more income than my employees. I have more assets. I've owned more real estate. And yet I have a harder time qualifying for a mortgage than somebody who works for me making $30 an hour. I don't understand it. The truth is, you're right, because the mortgage world doesn't look at things black and white. Okay. We look at, actually, maybe the answer is we look at it a little bit too black and white, which is the more complicated your financial situation, the more challenging it can be to get you qualified. And let's be honest, the goal of being self-employed is to not pay the most taxes you can. The goal is to pay the least amount of taxes you can. You know, the truth is, whether you own the business yourself or not, you automatically have a silent partner, and that partner's name is Uncle Sam. And so you've got to recognize you've got to pay your partner. Now, there are ways to legally pay your partner less. Well, if you have the option of saying, hey, I own this business with my partner, and I can legally and appropriately pay my partner less, and my partner's okay with it, wouldn't you? And that's what most business owners do, is they figure out ways to decrease the taxable income they show so that their partner, Uncle Sam, gets less money. In other words, they pay less in taxes. And that's common sense. That's a smart business practice to not pay more in taxes than you need to pay. And so it's important to understand, though, there are ramifications of that. The majority of loan programs are funded by the federal government through FHA, VA, Fannie Mae, Freddie Mac. Those are all government-related companies or departments within the government in some cases. And so you can't win with the IRS and win with the banking world in most situations. And that's the biggest struggle that people have to overcome is, how do I make this work? How do I qualify? And to kind of finish out this thought of what makes me more complicated, why is it harder for me? Because your income's not predictable. That's the truth. You may make really good income, but let's say it's declining and you made $500,000 2 years ago. Last year you made $300,000, and this year you're on track to make $150,000. Well, guess what? Even if $100,000 is enough to qualify you for the mortgage, the worry is the business continuing to drop, and that next year will be 100, and the year after that it'll be 50 grand, and the year after that you'll be closing. So that's the worry. Now, if you close your business, your staff person, the person we gave a loan to pretty easily based on their $30 an hour income, they lost their job too. But they're more likely to replace their income with a similar income working for your competition. doing the same thing they're doing for you, just doing it for someone else. But somebody who's self-employed, they aren't going to run next door and go to work for their competition if their business fails and make the same amount of profit, the same amount of income they were making when they ran the business. So the ability to replicate that income is unknown when you're self-employed. That's why we care more about the history. We care about what have you done for the last year or 2 years compared to what do the numbers look like today. Okay. Really, really important to understand that going into it. So a couple of tips. First of all, check with me before you file your tax returns. We have an anomaly this year in most counties in California that the April 15th deadline was disappeared. You don't have to file by April 15th. And so a lot of people haven't filed because, well, you don't have to, which is fine. It extends the amount of time that I get to help you review your taxes to determine, hey, what are my options before I file? Because once you file your taxes, that's the official record. It's kind of like your permanent record when you were a kid. That's your official record of what you filed on your taxes. There's some things that I can help advise you on. I might be able to say, hey, if you make a change to this, you might owe a little bit more in taxes, but it significantly increases the amount of money I can help you qualify for. Another example might be things like meal and entertainment expense, where I might say, hey, this is hurting you more than it's helping you. So let's rearrange the numbers a little bit and move the expenses into a different category if we can. So there's a lot of little tips that I can give you. I actually grew up in a tax preparation household, so I was an indentured servant, as many teenagers in my era were, where your family owns a business. My dad owned a tax preparation business, and I had to go to work during the tax season, nights and weekends, helping to prepare taxes and do the data entry. So I really got an early understanding of how taxes come together, and I've studied it more, and I have a good working knowledge of tax returns. So I can help you figure out how do we show those taxes before they're filed. Because once they're filed, you can amend, but an amendment doesn't eliminate the original record. And unless there's a really good valid reason why that amendment, like, hey, I forgot this 1099. I made $100,000 from this business, but I made another $50,000 from this business and I forgot to include it. Okay, that's fine. But if you said, oh, I'm revising my taxes because I overstated my expenses and my expenses are really lower, we won't believe you. We're going to believe the expenses were accurate in the first place and you're only changing it in order to qualify for the mortgage. So the first most important thing I tell people who are self-employed, if you are thinking of buying a home this year or next year, you need to come see me before your taxes are filed. Now you can prepare them. Matter of fact, I need you to prepare them because I have to know what the numbers are going to look like. Tell your tax provider, prepare them, and let's email the draft copy over to John before we file them. That way I can review it and give you my advice. The other thing to remember is sometimes the current year is all we need. There are opportunities, even within the normal conventional loan, Fannie Mae and Freddie Mac. There are situations where we can use just 1 year of taxes, and the year we are filing right now is the year that we can count. So maybe your 2021 year that you filed in 2022 didn't have enough profit, didn't have much profit at all, but you haven't yet filed 2022's taxes, which get filed in 23. Well, guess what? If you file them now and we show a greater amount of taxes, I can run your file through the computer system before you file the taxes to determine, do I have to average 2 years or can I use just 1 year? That's a big difference, because if you have to average 2 years and you had a really bad year last year, even if this year has the amount of income you need, the average is halfway in between. You'd have to show profit of double what you need to qualify in order to have the average equal what I need you to have, because I'm averaging 2 years. So it's very, very helpful when I can run your credit ahead of time, run it through the system, and see if it will let me use 1 year of taxes. Okay, so those are a couple of basic tips. What I'll tell you about taxes as well is people ask me all the time, John, do I have to show my business taxes? Sometimes. So there's some loopholes where I can use just your personal taxes. If you are a partnership, an S Corp, or a C Corp, I really want to see everything. So open the kimono, show me everything. I want to see what the profitability looked like on the corporate taxes. I want to see what the depreciation looks like because we can add that back in. But if the corporate taxes hurt us, it is possible sometimes to skip them. It depends on what program we're using, but what I'll tell you is show it to me, because sometimes what you think is bad, I don't think is bad at all. And so it gives me some flexibility if you show me what those taxes look like, that I can see what you're showing and I can help navigate and say, oh, I don't need these, that'll hurt me. And I can ignore those documents, including your business taxes. But anytime you are greater than a 25% owner of the business, then we have to see your personal and business tax returns unless we can get through one of those loopholes. And that's really another point, which a lot of people say, John, you don't get it. I'm just an employee of my company. And so can't I just look at my pay stub and W-2? Because as an employee, that should be enough. My employees are employees, and therefore I should be considered an employee too. Well, here's the problem. Your employees don't get to decide how much they pay themselves. And you're not likely to overpay your employee, even if you're losing money on the corporate side, on the corporate profits. But you would do that theoretically for yourself, because you're like, hey, you know what? Instead of me making $100,000 in W-2 income and zero profit, I'm going to pay myself $150,000 in W-2 income, and I'll just lose $50,000 in profit. You still made $100,000. Okay. It doesn't matter how you slice it. And that's what we're looking for, is we're saying, hey, just because you gave yourself a pay raise from $100,000 a year to $150,000 a year doesn't mean your business can support that. And so you're saying, hey, John, no, I got a pay raise, I'm good. If your employee gets a pay raise, we trust it immediately, no problem. If you give yourself a pay raise, we don't believe it. And the reason we don't believe it is because you have a vested interest. Hey, I'll pay myself more over here and I'll just lose money over here. It's no big deal. You can cook the books. You can play with the numbers, and the lending industry is onto that trick. And so they won't let us just use your paycheck stub and W-2 if you're greater than a 25% owner of the business. Now, how do we know that? What we do is a couple of things. We look at your taxes. So if anywhere on your taxes it shows that you are self-employed, then we're going to see it there. But hey, John, wait a second. I was told that if I'm just an employee, my staff person bought a home and they didn't have to give you their taxes. Fair enough. But we're going to look at the business ownership. So we always go to the Secretary of State's office and look up who the owners of the business are, who the officers of the business are. We're looking at the name of the business and the nature of the business. We're Googling the business. Underwriting is doing all of this work. And so we're going to see if it's likely that you're an owner of the business. And if there's any chance you are, we're going to ask for a letter from your CPA confirming if you're an owner. And if so, do you own greater or less than 25% ownership in the business? So if you don't own 25% of the business, maybe you only own 10% of the business, then I don't care about the business profitability. I only care about your paycheck stub and W-2, because in my eyes, you are considered an employee. Okay. So let's talk about what happens if you don't show enough profit, because we care about profit. And that's what people misunderstand, is they say, oh my gosh, John, I make $150,000 at my job. And I look at their tax return in my business, and I look at their tax return and it says $20,000 in profit. And they said, no, look at the top of the page. I brought in $150,000. I said, yeah, but you spent $130,000. No, I didn't really spend that. That money is simply money that I show as expenses. Like, I'll take my wife out to dinner once a week and we write that off because, well, technically we're talking about business, but we're eating anyway. And so that's not really expenses. We were going to pay that anyway. That's where you win with the IRS, but you lose with the bank. Because if you're telling the IRS it's a business expense, then the concept is your business would not be as profitable. You're not profitable. Your business wouldn't generate as much revenue if you didn't perform those activities. So it's really, really important to understand that we're looking at common sense, not common sense of, hey, I'm just trying to avoid paying taxes, but common sense of, hey, it says you brought in 150, but you spent 130 in order to get there. You only had 20,000 left over to pay for your mortgage. So what if you don't show enough income? So the first thing is we would look at your taxes and see, hey, if you haven't filed yet, let's coach you on how you can make those taxes look better. Sometimes it means we're going to delay our purchase and we're going to wait until next year when you file taxes and make those taxes look better. But let's go through some specific tactics on what we can do to make you qualify now. So the first trick that I use is something that is called trust income. And what do I mean when I say trust income? What I'm referring to is if you have a living trust or a family member has a living trust and you have cash that you can put into that living trust, we can actually count 1/36. In other words, we have to have the total amount of cash paid to you monthly over 3 years, and I can count that as income. I can count it as trust income because you're receiving payments from your trust. So that is one of my favorite tools. If your income is not enough to get you where you need to go, but you have assets, you have money in the bank that you don't want to spend for a down payment, great. You move it from your personal account to the trust account. You pay yourself a payment every single month for the next 3 years, and we're able to count that money as income to you, even though you don't get taxed on it from the IRS. It's a pretty good option. All right. The next thing you can do is you can get a cosigner. So what's a cosigner? A cosigner is a friend, not a friend, but a family member who is, you can't cosign for a friend. Lots of reasons behind that. I won't get into it right now. But the bottom line is that a family member who's willing to put their name on your loan that says, hey, my income plus my cosigner's income is enough to pay for my bills, my house payment, and my cosigner's bills and my cosigner's house payment. And if that's the case, the cosigner is agreeing they're going to help make sure you pay on time. So if something were to happen and you could not afford the monthly payment and you don't pay it on time, your cosigner's credit gets hurt because the thinking is the cosigner's on there because they're going to have skin in the game to make sure that you make the monthly payment every single month. So that's getting a cosigner, and we can use their income to add to your income to make sure we cover enough, that we have enough income. All right, here's another option, and it's a real option. Go get a real job. Now, I say that kind of as a joke, but it's true. I've had people who are self-employed that said, look, I could go to work in my industry working for somebody else. I'm a freelance web designer, and I could go to work for somebody in my industry, and I could get paid $60,000 a year being an employee web designer. Cool, go do it. Go become an employee. We can count your income immediately. Once you close escrow, hey, if you want to continue being an employee while you're growing your business, great. If you want to switch up, I don't care. We don't care what you do with your job after you become the homeowner. Now, I'm not telling you that you're going to lie. I'm not telling you that you're going to go get a job just to quit it immediately. But the truth is, if you decided, hey, I'm not making enough profit in this self-employed business, and I want to make that a side business, and I want to go work full-time. The key is being full-time. I want to go work full-time for someone else. I can count that income immediately as long as it is predictable income. So if you go to work and say, hey, you know what? I own a jewelry store and I'm going to go be a salesperson at somebody else's jewelry store. Problem is jewelry sales is commissioned income. At least I think it is. So you can't count that income as predictable. But if you say, hey, I'm a web designer and I'm going to go do web design for someone else, as long as they take you on staff and they pay you an hourly wage working full-time 40 hours a week, or they pay you a flat salary, I can count that income immediately. I just can't count both. So if you get a new real job, I can't continue to count the income from what you were earning on your other job. I have a client recently who had been doing DoorDash for quite some time. And the problem is that he'd only been doing it for about 1.5 years, and there wasn't enough history to count the income. And it was pretty volatile. He wasn't showing a lot of profit in the DoorDash income. And so his wife said, you know what? You need to quit DoorDash and go get a real job. And he did. And I was able to use the income immediately because I have a history that he has been employed, and he's still doing DoorDash on nights and weekends, but I can't count that income. But I was able to qualify them using the income from the real job instead of continuing to just do DoorDash. All right, so let's talk about 3 scenarios that will help you overcome the income challenge of what you report on your taxes as a self-employed person that go beyond the standard. Everything I've talked about so far gets you qualified under a traditional conventional loan. The next 3 options are not traditional conventional loans. You're going to pay higher interest rates and you're going to pay higher fees for these loans, but they give you some great flexibility that you otherwise would not have had. So the first one is a bank statement loan. What's a bank statement loan? Bank statement loan means that we are looking at the revenue from your business. So we're looking at your business bank statements, or if you only have one account, your personal bank statements. Then we are basically saying, hey, this is how much money your company has brought in. And we're counting that income that your company has brought in, and then we're counting an expense factor. We are decreasing. So if you, for example, deposit into your, if you have a single personal account or if you have a business account, doesn't matter. If you deposit $10,000 a month every single month, we're not counting that as income. What we're doing is we're saying, okay, $10,000 is revenue, how much money the business is bringing in. Now, what are the expenses? Now, there's different ways we can calculate the expenses. Some programs say, hey, we're going to calculate the expenses based on the type of business you are. If you're a product company, meaning you sell products, well, then you're going to have a higher cost of goods because you actually have to buy the product and resell it. So out of that, if you sell cars and you sell used cars, you're going to buy a used car for $8,000. You're going to turn around and sell it for $9,000. So there's not a lot of profit left over. There's about $1,000 in that situation left over, versus if you're a consultant that works out of your house and you do billing for $9,000, most of that $9,000 you get to keep because you don't have to buy a car to sell it. You're selling your knowledge. You don't have to pay for rent or parking spaces or anything like that. So it's going to vary what percentage of the revenue we get to keep and count as profits. But either way, the fact of the matter is we've got a lot of flexibility because we're using the bank statements to prove what your revenue is. Now, if you happen to have both personal and business accounts, and it's clear that you use your business account for bringing in all the business income and for paying all the business expenses, we can use your personal account, as long as we can prove the business account exists. We can use your personal account and count 100% of the deposits. Why? Because the money coming into the business and the expenses going out of the business are expected to be handled through that business account that we're not counting. So any money that flows into your personal account is what's left over after expenses, and that's 100% yours. So it depends on how you run your business. And this is a good planning tool for people who are thinking about buying a home down the road. And they're like, John, I'm never going to show enough income on my taxes. Then start depositing every penny of what you bring in and deposit it into a business account, and then pay the expenses out of there and transfer the money into your personal account. That's a very, very good option to allow you to qualify down the road. With business bank statements, we typically need anywhere from 6 to 24 months of bank statements to come up with the average. So it's really going to depend on what type of loan I'm doing. And you're looking at higher down payment requirements, most of the time 10% to 20% minimum. And you're looking at higher interest rates. Right now interest rates are pushing 7%. So what is considered high? 7% is a normal loan. So if you're paying higher than that, you're probably paying 8 or 9% interest rate. But that's not so bad for the fact that you're qualifying for a loan without having to pay extra taxes to the IRS. All right, 2 more things before I wrap up today on this topic. And that is, what if you're buying an investment property? Well, if you're buying an investment property, you can do something called a DSCR loan, or a debt service coverage ratio. That means if the rental income coming into the property is enough to pay the mortgage payment on the property, you qualify without proving anything else. So that's an opportunity where if maybe you own an investment property and you're trying to do a 1031 exchange, but your lender says you can't, or you're afraid that you can't because you don't show enough profit on your taxes. But you know that if you sell the property in Tennessee and buy a property in Hawaii, you're going to make more rental income on that Hawaiian property. So we can qualify you using the rental income, and I ignore everything else. I don't look at your taxes. I don't look at how much you pay on your mortgage, or how much your credit card payments are, or how much your car payments are. All I care about is the income from that rental property enough to cover the payment on that rental property. Okay. Finally, and this is probably the scariest of all, but this is a product that is now available. We're back to some options for no income documentation at all. On a primary residence, I have a loan that will allow you to buy a primary residence. Now you have to put at least 20% down in most situations, but I can allow you to buy a primary home and I don't care about any income. I don't need to see any tax returns. I don't need to see any paycheck stubs. I don't need to see any W-2s. Now, these loans are going to have higher interest rates. You're looking at an 8 to 9% interest rate. Sometimes they'll be fixed. Most of the time they're fixed rates, but a lot of times they're going to come with a prepayment penalty that says, hey, you've got to keep this loan for 1, 2, or 3 years. So there's definitely risk there, but if it's the only way for you to accomplish your goal, and it's that important to make the goal happen, these options are there. The thing we have to be careful about as an industry is to make sure we're not offering these to everybody, because that's how we got in trouble back in 2005 to 2007. We were doing loans where there's unique circumstances that say, hey, I know you have enough income coming in. We just can't prove it. So I can go with this alternative loan program. That's what these are designed for. It's not designed for someone that doesn't have a job, has no income, and says, I don't know, I'll just figure it out. I mean, obviously the bank wouldn't give me the mortgage if I couldn't afford the monthly payment. Well, that is not so true. And that's where we've got to make sure we're using these tools appropriately and making sure that we're not setting you up to fail. But the fact is, if everything else fails, you're not able to figure out a way to get yourself qualified, I have options to help you buy a home, a primary home with no proof of income using this option, or an investment property using the DSCR option. All right, so I know I covered a lot. I want to open it up to questions. If we have anybody on that has questions, feel free to post into chat. If you're watching recorded, feel free to post into the chat and I'll follow up with questions later. But here's the most important thing. If you are self-employed and you are thinking of buying a home in the next 1 to 3 years, you need to talk to me now, because the sooner we talk, the more we can plan and figure out which of these avenues is going to work best for you. Which one's going to give you the best interest rates while still minimizing how much money you're paying in taxes? And sometimes it means we're going to take a program that has a higher interest rate because it saves you so much more money compared to what you would pay extra in taxes. And that's a very, very important thing to understand. Interest can be temporary. The money you paid in taxes is permanent. You also sometimes raise a red flag with the IRS because, hey, you showed a lot of profit one year and now you're back down to lower profits. I don't know if that's an audit flag or not, but I know I would be concerned. So it is something to think about, and that's why I wanted to present this to you. So gang, I really appreciate you joining me today. If you have any questions about anything at all, whether you are self-employed or not, I would love the opportunity to help answer your questions and guide you through the home buying process. So I really appreciate you. Hope you have an absolutely wonderful Memorial Day weekend, and we'll talk to y'all soon. Bye-bye.